Good morning, everybody. Welcome to the Flow Show. It's NFP day and we're all ready and excited. But before we start, just a reminder that we have a big announcement coming on Face today. That's the Face webinar. And I've just popped the link there. If you're already registered and you already have access to Face, then don't worry, just turn up as normal. For anyone else, you can register there. It's the same as registering here for the Flow Show. It's free, of course. Hopefully you know about Face already, but it's led by the famous Coach Dale, and he leads all his flock, or tries to lead his flock to some good profits. So pay attention for that one later on. In the meantime, we've got our stuff to do here. Morning, Kay.
Good morning, Ryan. Good morning, everybody. Thank God it's Friday.
Yes, indeed. It's been a long week for me.
Yeah, it's already a long week, but it's a busy Friday today on many fronts, right? So
yeah,
I guess the people should really stay with us, especially over Face, but also now because we are hopefully preparing you for what's to come on the US and Canadian jobs report.
Yeah, double bubble today. We always like a bit of double bubble here at the Flow Show. So we'll get stuck right into it and have a look at what's going on in the world. Over in Japan, the head man Ueda at the BOJ said chance of sustainably and stably achieving the bank's 2% inflation target is in sight. Says we'll adjust the level of interest rates in accordance to the distance towards sustainably and stably achieving the 2% inflation target. He had a few more comments about things like energy prices when the government stops their subsidies for energy prices. That will affect inflation, and a few sort of leaning comments towards when they might next, or the conditions for raising rates again. So as long as they stay on this path, inflation keep going, wages coming in decent as they have been, and this virtuous economic cycle picks up, then that's going to lead to them looking to increase rates again. Probably later in the year, we'll be playing the timing game again. Suzuki out with some of his usual jaw-boning waffle, but he declined to comment on whether the recent dollar-yen moves are excessive. That's one of their conditions for intervention, as to whether moves are excessive or not, and he remained tight-lipped about that, giving nothing away over there. The jaw-boning bombardment continues. Kishida as well, also jaw-boning as well. And it's not often you get the PM so heavily into the jaw-boning as well. It just shows that they're all bang on it at the moment. Anything you took from any of those comments last night, Kay?
Yeah, the second time, if you read, second time Ueda mentions FX. And normally the Bank of Japan is, as we know, is not responsible for interventions also. But if the yen stays weak, he is hinting at the fact that it may facilitate more rate hikes. That's the interesting part. Yeah, Kishida is like the second or third time already in the past two weeks or so that he comes online. And of course, I mean, we as active market participants and the whole market is now eyeing at that 152 in the dollar yen, and I think they use it in a way. They use it to it's not them up there, but they use it to keep the market on its guard. So I don't think they would intervene if the rest of the dollars go up and as a result of all a bit dollar yen goes through 152 in a slow orderly fashion. But they seem to have found this level. They must know what's going on up there as well. And they seem to use it now psychologically to send warnings into the market. But I mean, it's still all a result of what happened after the Bank of Japan decision, right? Because well, they and a lot of the market was expecting the yen to strengthen a bit after the first rate hike, but we had exactly the opposite. We had the buy the rumor, sell the fact scenario. And so now they're nervous about this because they also now start to think, well, if the Bank of Japan, even if they go 1/4% or so, call it September, October, second half of their fiscal year, it may not give the desired impact either. So and I think that's where, if you take all those comments in context, and I think that's perhaps also the reason why Ueda for the second time mentions FX as well, that it may facilitate rate hikes. For now, the only result that it had was dollar yen shying a little bit away from the 142. But if you look at the crosser side, it still remains quite well offered, and we're still not far away from the 152, right?
Yeah.
The one impact that it had is that the curve in Japan is slightly moving up. So we are back at above 20 BPs in the short end, and the tens are just slowly creeping up now. We're above 3/4% now. We are around 77. We had a quick blip on Wednesday up to 80 BPs that came back off. Now we seemingly like starting to build a base in the 75 BP zone. So yeah, that's the effect that it had, but very little more. I think yesterday the job that we saw was risk related, and likely some of the 152 hunters having to give up the fight a little bit, managing the positions. We are ahead of the US jobs report, so a bit of a combination of everything to see the dollar yen shy away from the 152.
Yeah, very much so, and we'll talk about risk in a moment. But it was going to be interesting if this was sitting up near 152 over the jobs report to see if that would be the trigger, a good number there to send it through. But 60 pips away, that probably puts it in hold territory unless we get a gangbusters number. So it's going to be an interesting watch later on anyway. Right, coming over to Germany and some trouble in the commercial real estate sector. German banks saw their non-performing commercial real estate loans jumping to 13.6 billion from 9.7 billion euros in Q3. Those are Q4 numbers there. Just for those who don't know, non-performing loans are people who basically are struggling to repay their loans. Germany's been one of the countries that has had a big question mark over it in terms of worries about commercial real estate. We obviously know the problems going on in the US. Well, Germany's got a bit of an issue there as well. So just something to keep an eye on that front. On the economic data front, though, more green shoots by the looks of things. We had factory orders that have been a bit of a disaster recently. They came in better. Let's get on the right date so we can see those. Factory orders not beating expectations or even matching expectations, but still turning around that awful 11.4% loss to post a 0.2% gain. Still sucky on the year though, down 10.6% year on year. That was worse than the -6% we saw last time as well. On the inflation front, import prices there as well, still coming in with negative numbers for that one as well. We've got some construction data out as well as some industrial production data from some of the other countries. A lot of these still in negative territory. Germany going further into contraction in construction. All these numbers not looking overly hot. Italy, the only ones seemingly doing okay out of that lot. And as you can see there, industrial production from Spain doing okay as well. Retail sales in the Eurozone worse than expected as well for February. No surprises on that front. Bloomberg survey of the ECB, of economists talking about the ECB, see them cutting once per quarter until the rate gets down to 2.25% late in 2025. The ECB minutes were out yesterday as well. Most of the headlines, what we already know. I just picked out the choice comments. There had been further progress on all three elements, which warranted increased confidence that inflation was on track to reach the target. The case for considering rate cuts was strengthening. There was consensus that rate cut discussion, though, was premature at that meeting. And here's something funny for you. They also said that at the March meeting that they expected oil prices to decline. And there's your decline in oil prices. The March meeting, where was it? 7th of March. So right in there, and that day there, and there's oil prices after that. So that's why they don't make good forecasters, and probably won't make good traders. They do at the Fed, though. They like a trade over at the Fed, as we know. Back over to the US, we had some layoffs data out yesterday. Challenger Great layoffs, totting up all the job cuts that we hear about. And it was a bit higher than it was last month, as you can see there, 90,000 versus just over 84,000 the month previously. So these numbers are now starting to tick up quite a bit, these job cuts coming in. We always hear about the big firms and everything, but there's plenty of others as well who are starting to pick up. So that's just starting to form a little bit of a trend there in those job cut numbers. Not that you know that there's any problems. Initial jobless claims coming in pretty much A-OK, as it has been recently, 213, a better number than expected. And those continuing claims also dropping below the 1.8 million. There was a moment a few weeks ago when it was looking like it was going above 1.9 million, but it's pulled all the way back there. So no problems there. But there are a few questions now being asked about this data and why this data is looking okay when other things like quits and the jolts and other metrics, PMIs are showing a weaker picture. So that's got some of the propeller heads asking what's going on with the data. As far as the Fed is concerned, Fed's Harker says inflation is still too high. Fed's Barkin says it's smart for a US central bank to take our time on interest rate cuts. This was the first of a set of comments that is sounding a bit more hawkish and a bit more cautionary about cutting rates. He says that early 2024 data is less encouraging and raises the issue of whether the outlook is shifting. He's still looking for a slowdown in reported inflation to sustain and broaden, but says it's hard to reconcile the current breadth of inflation with progress the Fed needs to see for rate cuts. Fed officials are all looking at the same data, but it's easy to draw different conclusions. Then speaking on their framework review, says he would be open to discussing a range around the inflation target as part of that review, which I think is something we're going to see. Once rates have come down to whatever neutral level, inflation is doing okay, and things, touch wood, are all calm and normal, shall we say. When they look at their frameworks, I think a lot of central banks might be looking at setting up a range, so moving away from this explicit 2% target and setting up something maybe similar to the Bank of Canada, where they have the 2% target, but it's in a 1 to 3% range that they're happy to let inflation wander. ECB, they have a target, but their actual target, the wording of their target is inflation close to but below 2%. So it's not a set 2% target. That's their official wording, close to but below 2%. Anyway, Fed's Goolsby, another one who's getting a little bit itchy, shall we say, about the prospect of inflation not playing ball. Says the biggest danger to the inflation picture is continued high inflation in housing services, and that if housing inflation does not come down, it would be difficult to return inflation to 2%. And housing inflation is his most valuable indicator for the immediate future. He says the last 2 months of inflation data is a bump, but you can't write it off as purely noise, which again is a bit of a change of tone. Some of these Fed heads saying at the last couple of prints in CPI. Oh, you can't judge 1 month, whatever. But now maybe they're getting a little bit more worried about that. He said in March he jotted down 2 rate cuts this year, but then said if inflation continues to move sideways, it makes me wonder if we should cut rates at all this year. That mood was also picked up by Kashkari, who says we need to see more inflation progress before thinking about a cut. And he said it's possible the Fed won't cut this year if inflation stalls. He also wrote down 2 rate cuts in his March projections. Mesta says thinks that growth this year will now be above trend. Says that she doesn't think the disinflation pace this year will match last year, but still anticipates they'll be in a position to lower the Fed funds rate later this year, but needs more evidence inflation is moving down. She wants a couple more months of data to assess it. It says the Fed is well positioned to respond to both sides of the mandate. Okay, they're getting a bit twitchy over there, aren't they?
Yeah. Yeah, it's strange because Goolsby, who was who when he came on was rather on the dovish side of things, is slowly turning and seemingly a bit nervous about stuff right now. And I think the other thing is that there's something strange going on because I think there's some body invaders turning around these central banks, because Holtzman used to be at the ECB the Uber hawk. Now he's turned around, but then Kashkari has caught the virus now of becoming an Uber hawk. So I think there's something strange going on there. There's some alien invasion in the central bank, Anyway, yeah, I think Kashkari is just too hawkish right now. But we will see. As they are turning around, like the market is turning around now, and that is kind of typical when I say like, this is we could be in for a bit of a messy second quarter, start of the second quarter, and we are starting to see it. So. That makes us even more data dependent, I reckon, especially now we are just ahead of that US jobs report. It's going to be a big one. The central bankers can only judge on the data that they are going to get as well. So that's where we are at right now, right?
Yeah, very much so. And it's, we were talking yesterday about, after Powell, the market sort of unwinding a bit, unwinding some of its hawkish leaning, shall we say. These comments are fairly hawkish. Talking about not cutting at all is fairly hawkish sounding, but we're not seeing that move reflected in prices. And that's, I think, a big part of that is these headlines we've had from Iran and Israel, this tit for tat going on there that may lead to a greater conflict. That's hit risk, really, as we've seen in stock markets. We've seen a bid in the yen and the usual characters. Now, the dollar, in other times of risk off, the dollar would be a buy in those situations. You'll usually see dollar gaining. But by proxy, if this kicks off between Iran and Israel and it gets quite big, then the US is going to get dragged into that in one way, shape or form, just because they're allies of Israel. So that's probably a reason why the dollar isn't gaining in this risk-off mode. But stock certainly took a battering yesterday. Big losses all round. S&P really crunched through all the levels. And this is one of those moments where really the headlines don't give two monkeys for the techs. We were talking this yesterday, bounce off support. Well, doesn't give a monkeys about support when you get risk headlines like that. I think if the story eases somewhat, if we don't get any dramas over the weekend or things calm down, then we probably see stocks climbing back up. But I think going into this weekend, we've got to be careful that traders reduce risk further with possible weekend risk, headline risk evident and growing. So that's something you need to be careful of when looking at trading the NFP. It's not going to be automatic that if you see stocks moving higher on, well, I don't know what they'll move higher on, a good number or worse number these days. But any reaction that's positive risk over the NFP today, you need to be careful with, because that may not last and that may peter out into the latter part of the day. As I say, people deleveraging from risk for the weekend. Anyway, let's have a look at the non-farm payrolls data and the Canadian jobs data to come. 212 expected from the NFP, so there or thereabouts in that positive area. Again, as usual, anything above 100k is going to be taken positive. The higher it goes, the more positive it's seen. Usual caveats apply, though, in what to look at. The wages are going to be an important number as well. They've been staying sticky in that 4% for quite some time now. Obviously, the unemployment rate got a little bit of surprise when it started coming back down again. It was creeping up. It's expected to remain unchanged at 3.9%. As usual, you've got to match that off with the participation rate, because that can affect what we see there in the unemployment rate. Participation rate rising means that unemployment rate could rise as well. So look at the unemployment rate, then see what the participation rate has done as well. What's important today from the NFP? Is it going to be inflation, the headline, unemployment, Kay? What's your marker?
Well, today I think it's going to be the package, and we've seen those NFP. The NFP number actually has been a bit of a blind darts one, because every month we get those negative revisions, right? So the doomsayers, if assuming that we get another decent report, the doomsayers will always look at this. But the revisions are negative. The best thing, or the smoothest report today would be, I think, anywhere 100 may already create a little bit of a doubt in the market, but like somewhere 150 and above. Unemployment rate staying below 4% or just nudging at 4%, and then the wages staying above 4%. That's going to be like the smallest positive number. The thing is, I've got difficulty to see when you look at the ISM, when you look at the employment indices, when you look at where we're talking about the jobs, when you look at all the rest. I mean, it's difficult to see how those reports can really hold up so well. So a bumper good report will be somewhat of a surprise. And then I think the other side, that's the danger one today. The danger one today is because, and I've repeatedly been saying that, like Power last week, Friday, has confirmed what I've been thinking for a good while now, is that they are starting to look really at the full dual mandate. So not only inflation. So employment is important. And if we would get a bad report, that is an unemployment rate above 4%, wages coming down, and a lower non-farm payroll, then I would say, like, be very, very careful what happens this afternoon, because I think in that scenario you can see, like, the algos are probably going to have like a little knee-jerk reaction higher in the stocks, because the yields will be coming off, but then I think it's going to get absolutely hammered. And so the initial reaction may be lower dollar, then perhaps a bit of a spike due to the correlation, but then afterwards it could be a very bad day for the dollar, actually, if the report is really weak. And then you have to look at risk as well, because, for instance, what we have seen yesterday as well, there seems to be a bit of over positioning, likely in stuff like the Swiss as well. So we have seen a pretty good setback in all things Swissy. So that is one that we will have to pay really good attention to, especially, as you already mentioned, ahead of that weekend, where we can have some geopolitical risk in the Middle East. So I mean, if it's a really bad report, then I would say, like, be very, very careful, because the floodgates could be open on quite a bit of risk, quite a bit of dollar pairs. Really, I think we have to be very careful if it's really a bad report. So that is going to be for me the most worrying thing, or the one where we will get, or we should also react the most. It's a really bad report. Okay, so because that is going to facilitate the rate cut scenario, independent of inflation, and also let's not forget a slowing down employment market with lower wages and things is disinflationary. So
Yeah.
the market will put one and one together and say like, well, this is not this is something where really we need to react upon. So that is my thing, that a really bad report is really going to make people react the most, I think, in the market. And get a very good report, then we are going to have like the usual repricing. Then I think the US 10s, we will have to look at the full 40%. It will be a decent reaction on a bumper report again, because we are expecting also reports to start to show weaker data, and the market is flip-flopping a lot. But I think the biggest response will be on a bad one.
Yeah, no, I agree with that. And a good one, as I say, a good one if it lifts risk assets. That's something to maybe look at to fade. That's something I'll certainly be looking at, given the worries that may happen going into the weekend. So, yeah, there's not many scenarios where the dollar is likely to gain and hold those gains and see those gains significantly. So, hopefully, what we've discussed here gives you a bit of an idea which way to lean and how to trade this thing, depending on what it is. But there's more chance of dollar rallies getting hit than dips being bought, and the dips are likely to be bigger than the rallies, if that's the way the data flows and what's going on in the world as well. Canada jobs as well, as you can see there, they're probably going to take a bit of a sideline today unless there's a big variation, unless we see some really collapsing numbers there that may get the market thinking about the BOC hinting stronger about cuts. This one might just be a bit of a part-time show to look at, but same thing applies for the data. Look at the overall employment change, then we see what happened on the revolving door. Was it in part-time, full-time, whatever? Get some wage numbers out there as well. Unemployment rate, again, match it off with the participation rate. Then the other thing is when you get a double bubble or double header with Canadian jobs, US jobs as well, it can be a double wind or opposing winds. So just, if the US data is good and the Canadian data is bad, then obviously the loonie is going to go up more, and vice versa. If they're both equally as good or bad as each other, then the dollar side of things is likely to take over, as opposed to the Canada side of things. So the best thing to do, if you like trading the loonie, plot your levels. We know that this old 136 zone is a bit of a sticky one. We get up there. Where are we? Here it is.
And also, Ryan, speaking about those Canadian jobs, next week we have Bank of Canada. And so for the Canadian trade, those who trade Canada, keep that one in mind as well. So for the Canadian currency, for the Canadian dollar, there is actually three things to take into account. It's the jobs reports today, how it compares to the US, the weekend risk. Because I mean, if imagine something happens in the Middle East over the weekend, and we open with big gaps in whatever oil and other commodities may be concerned. So that is a risk. And then the 10th. When is the 10th? Is that Wednesday?
No, Tuesday.
No, the 10th. No, the 10th is Wednesday.
Sorry. Yeah,
the 10th is Wednesday.
So,
and on the 10th we have the Bank of Canada. So you've got like really a lot of things to take into account if you trade Canadian dollar, and a lot of things can push and pull the Canadian dollar into and over the weekend. Okay, so to be honest, personally, I may actually, regardless what this report is in the Canadian employment report, unless we got like really a bumper number somewhere, I may not even get involved in the Canadian dollar because there's even more uncertainty there possibly than in others, especially if you would get a bit of a weaker one.
Yeah, very much so. It might be worth steering clear of dollar CAD and looking at some of the other CAD crosses, Euro CAD,
Yeah.
and the like. But yeah, we know where the trouble points are, up in the 136s. And if you take the spiky move out of the consideration point, 135 down below 134.80, that's going to be the area to look at on the downside. But you've got to match it off, match the data moves, and then price it against what risk markets are doing as well. That's going to be very important today. So yeah, we were looking. I was looking quickly at stocks just to see what was going on there. We had the big carve down, as said. So I'm not really going to pay much attention to all my little lines in here. These are all my short-term drawings, as you know, as and when the prices reacted the way they have. I'm going to ignore these while we've got this risk move on. And just focus on my bigger zones, these blue zones. They're the ones that are likely to stand up to any big tests. It'll be a bit of discovery what happens around here. Some of these levels may show up, they may not, I don't know. I'm just not going to trust them as much with these risk headlines going on. So my big level won't be down until 50.50. I am inclined to be a dip buyer, but I'll need to see this war stuff dissipating, turning into nothing. But then we need to see what happens. Are the sellers going to be grasping what's happened here and trying to push their case, making it tougher for rallies to get back to those prior highs? I suspect that's what they're going to want to do. They've been waiting a while to try and smack this one properly, and they keep getting turned around. But this is one of the bigger moves down we've seen in the whole of this rally. So sellers won't be too quick to try and give that up. So look around that 51.80 into 52s for first signs of troubles that sellers are coming in and protecting this move already. Get it back above that, and we're probably going right back into this area here.
I have a doubt today. I doubt that unless we get a really bumper report out of the States and really painting a very rosy picture that we can really get back up to lofty levels. I think today as well, the danger is the danger move. Let's put it that way. The danger move, not the move that will happen, but the danger move. In taking into account the weekend or also the geopolitical risk, is the danger move is still the downside for this one, right? If you get a really bad report, it could really get hammered, and your 50.5 will look you straight into the eyes, I think.
Yeah. Well, I mean, that's the other thing. It depends how the market wants to take it, because we've got this risk play. Usually a bad report means the Fed will cut sooner, which usually means stocks go up. But because we flipped around this risk trading, I don't know whether a bad report sees this go higher or lower, and vice versa, a good report. Suffice to say, I'm probably not going to touch it this side of the weekend, whatever happens.
No, even if it's like a decent report, let's say, and there's no risk event happening over the weekend, then the market will go back into its collective Alzheimer scenario, and we may gap open. We may open higher, but you will also have a base of then trading in again ahead of the weekend. As I said, the risk is really for a lower one, and even if we can get a gap back open higher on come Monday morning. But today I would be very, very cautious. I mean, and again, especially if it's a bad one.
Yeah, very much so. Right, let's have a quick look at some of the others, then I'll hand it over to Cayman. Dollar yen. So again, this one, are we done with 152? Probably not. No surprise to see where the low topped out at. This old resistance point. We had a smash through previously, but it's back in again now at 158s area. We've already climbed, a good 50, 60 points above that. So we're not done with this 152, not by a long chalk. But again, risk is playing into this. You would have thought that some of those more hawkish sounding comments from the Fed head yesterday you'd expect yields to be a bit higher, the dollar to be a bit higher. The fact that it wasn't through all those comments tells you exactly what we're trading here at the moment. So again, I might favour a little dip buying this. But again, you've got to worry about that risks. If nothing happens over the weekend, let's say we've had a poor NFP, nothing happens over the weekend. If we're down sort of 150s, maybe I might be inclined to try a little feeler long, tight feeler long early on Sunday or Monday morning, just to see if we get back up towards that 152, because I don't think we're going to be done with it for a long while yet. And as Kay mentioned, yields, yeah, it's come on, click in. Yeah, this 440s up in this area, that's the main area at the moment. And obviously 420s down below. We couldn't really get and break below that. So that's going to be a test again. You know, poor data. We come down here in yields. Then if we hold that level, that will probably put the brakes on any dollar move for the time being. So you always got to have an eye. You know, we've got to have 50 eyes in this game, and eye on everything. Eye on risk, eye on yields, eye on the dollar, eye on everything else. Need to be a spider, I think. Kate, do you want to take it for a couple?
Yeah, just a couple, mate. Just a couple.
Let me. Where am I going? There and there. All yours, mate.
Thank you. Again, it's going to be a naughty one today. As we've already been talking about, there's a lot of risk flying around in the markets right now. So I know we are traders and we always want to trade, but I personally will be more than happy to, if we don't get too many waves this afternoon, to just let it run into the weekend, let most of it run into the weekend, see where we are on Monday morning, okay? Because if the Middle East situation deteriorates, or on the other hand, if it's like a wet sprocket, we could gap open on Sunday night, Monday morning, regardless of today's reports. Okay, but looking at the levels and where we close. Okay, we've had and we've tested them, we've traded them, we've broken under, we've broken back above. We've seen this level trade here. Euro dollar, it's all about what's happening around 108, 10 right now, or 107.95, 108.10. That's your underside, and the top side is 108.80. Again, here I think the bigger risk. That's how I see how it trades since yesterday as well, since the day before on the US data. I think the bigger risk is for a bigger move is going to be on a bad one. We have to mention again that the options markets are still not very nervous. The overnight straddle in the euro dollar is still covered by 50 points, so they think that we are not going to get out of that range because the 50 points is exactly 107.90, 108.90. So expect some activity over there because it's still not too expensive. Sorry. To buy options. So we are going to find interest on both sides of the of that range. Has to be said that on the last batch of numbers, we exceeded the option range, expected range. Okay, so the last one did. All the prior ones they really kept it in that range especially on the euro dollar, right? But I think there's a bit of a risk, and I would say especially this side if we start to break above, and then we are going to talk again about our 109.15 prior tops as well around 109.40. So my own impression is that the bigger risk is for a weaker data number. This sterling is a bit bizarre because if you say bad for risk, yeah, dollar will get hit, cable is going to fly, but the problem is that sterling is a bit of a risk currency as well, and we may not get up into those well, we can get up into the 127s. That's not a big problem, but I think cable may be more rangy than actually the euro, and one of the reasons is this one, and that's the euro sterling. And this euro sterling, I've got the impression that the market or some participants in the market are starting to, and right or wrong, I leave that in the middle, but are starting to think that the Bank of England is going a little bit more less hawkish and starting to lean towards the a little bit more dovish, but I wouldn't call it outright dovish. And everybody has his own opinion about it. I don't think they are the first ones to cut, but let's see. Some people seem to start to think, and I find it a bit strange that since the start of the week we are seeing like the euro sterling continuously testing this bit of a trend line here, and we are trading on it. Yeah, it's around 85, and that's where risk comes into play, because if you acknowledge that the sterling is a risk currency, if we get a really bad report out of the US this afternoon, and if you want to steer away from the dollar, this could be one that actually continues to creep higher. Okay, so this is the game of correlation. If the sterling really trades with risk like it can do on a really bad report out of the States, cable will fly, but then likely this one could actually start to break up a little bit. So that's one that I'm going to keep an eye on. Yeah, really Canada. I'm not tempted to trade the Canada, as I said. EuroCAD is trading in this. Well, it's looks like a bit of a megaphone, but the 146, 146, 590, 146. It again shows difficulties to stay under. We traveled under it for a while here, but it looks as if it's relatively easy to jump back higher. And that is also one that I would say risk off could lead this one higher back into the mid 147s, I reckon, for at least a test of the top side here. That's the risk, I think, especially as well that we have seen those oils tick higher. And yet the Canadian dollar only benefited for a session or two, and as I said, Bank of Canada next week. So positive numbers, perhaps dollar Canada back trading around 135 the figure. Negative numbers, watch the crosses, I'd say, or watch the 136.15 on the dollar CAD. That could be a break zone. A break zone as well here. That's a possibility, and then we're going to test the high 136s. But it's not my favorite. It's not my favorite trading currency. Okay, Swissy. We've had this setback in risk, and I also think a bit of over positioning. And we've seen a setback on all the Swiss pairs, whether it be dollar Swiss, euro Swiss, sterling Swiss, the main ones that I'm watching. But all the Swiss pairs got a bit hammered yesterday, and but we are still, and I would say this one relatively comfortably holding inside this this channel. Okay. 97.40, 97, yeah, 97.40. That's where we have to look how we close the week. Again here, if you get a really disastrous number out of the US, watch out for those Swiss pairs, because Swiss is likely going to strengthen, okay, despite the lower inflation, despite the higher foreign FX reserves numbers that came out this morning. By the way, it was a pretty decent jump, like nearly 40 billion Swiss worth, which is also to big parties we can explain through revals, because the Swiss franc has been weakening during the month of March, as we see here, has been really weakening. It's weakened more than 2%. So a lot are revals, but perhaps not everything. I think there's a bit of outflows out of Switzerland as well happening. But at least the reserves are ticking up. So that's still a positive for ultimately a weaker Swiss franc, but be careful ahead of the weekend. Be careful on a very weak US data. People will want to reduce their positions further, and we could see a break of this before the weekend, okay? And I wouldn't even rule out that we print a 96 or somewhere if we get a really bad US report. A good US report should in turn be relatively supportive for all things Swiss. But I still think it's not going to fly away before we start the next week, okay? So sterling Swiss did exactly the same, but as I said, sterling looking just that a little bit weaker than the euro right now. So we actually went to test the first line of defense here on the channel around 113.70. But again, we're holding. So people who are in the position are still relatively comfortable. I did reduce some of my positions yesterday because of the geopolitical situation, because of looking at the equity markets crashing yesterday. So and I do think that the market is quite well positioned for a weaker Swiss right now. So we cannot exclude more rebalancing or more reduction in positions over the into the weekend. Next level here, 113.40s or so. And again, if it's a disastrous report, I would not even exclude if we print 112s at some stage, which would still be only 23.6 retracement of not even. Where am I? No, that's not even there. Yeah, 23.6. Okay, I should extend it just a little bit, but it was the first move here, still around 23.6 only of that move if we get down in the 112s, but channels will be broken and the market will probably be a little nervous, okay, especially if it goes accompanied with lower stock markets. All right. And that is it for today. I'll see you all on the Face Show where we will comment about the NFP coming out. It could be a very big mover, so watch out for it, okay, guys? And back over to you, Ryan.
Thank you very much, mate. And you're absolutely right, Gavin. Know when to trade and when not to trade. Sometimes not trading is the best strategy, depending on the market conditions. And we should call that a week. Thank you very much for coming to the Flow Show. Give us your support and giving Kay your support while I was off on my jollies. Back to normal full week next week. Lots to happen. Have a great week, and if everyone trade safe over the NFP. Watch those risk headlines going into the weekend. We'll see you all next week. Have a good one. Cheers, Kate.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.